Listen carefully, because the most dangerous moments in any market are the ones that look normal on your screen. The chart can look calm, the spot price can look contained. And underneath that glass smooth surface, the physical market can already be cracking. This is Money and Empires, and today S report is titled JP Morgan Insider warns silver stress at 7%. Institutional physical market broke. Here's the hook. When stress hits a certain threshold, the system doesn't fail like a movie explosion. It fails like a freezer. The flow stops. Quotes disappear. Deliveries get delayed. Mints pause. Dealers limit. And the paper price becomes a number that only exists because someone's still willing to pretend. Today, we were talking about a warning signal that keeps showing up right before the freeze. A stress reading around 7%. Not a headline number, not a meme. Think of it like the pressure gauge on a boiler. You can ignore it at 3%, you can argue at 5%. But around 7%, people inside the system stop joking. They start calling lawyers, they start calling logistics, they start calling everyone who can get them metal now, not next month. So what is 7% stress? In plain English, it's the market admitting the truth with its body language. It's the cost of immediate metal. It's the premium for certainty. It's the extra money you pay to replace promises with atoms. And when that number pushes higher, it's telling you something uncomfortable. The physical market is beginning to price silver differently than the paper market. And once that divorce starts, the final outcome is always the same. Paper has to chase physical, or paper breaks. Why does this matter? Because silver is not just money, it's industry, it's solar, it's electronics, it's defense supply chains. It's the metal you don't notice until you can't get it. And when a metal is both monetary and industrial, the shortage doesn't stay in one corner, it spreads. Everyone needs it at the same time for different reasons, and that is how stress becomes systemic. Now let's address the phrase that makes people angry. Physical market broke. That doesn't mean there's zero silver on Earth. It means the market mechanism is broken. It means the price you see is not the price that clears real supply. It means there are sellers on screens, but fewer sellers in warehouses. It means you can buy the idea of silver instantly, but you can't necessarily buy the metal instantly, at scale, at the posted price. And when that gap opens wide enough, that gap becomes the trade of the decade. It becomes a vacuum that sucks metal out of weak hands, weak jurisdictions, and weak promises, and moves it into strong hands and strong vaults. Now, why? JP Morgan Insider warns. Because JPM is not a random player in silver. JPM is a pillar, a fortress, a plumbing station in the system. Even if you don't like them, even if you don't trust them, you have to respect their position in the architecture. They sit at the intersection of paper flows and physical flows. They see stress before you see headlines. And when people around that fortress start whispering about 7%, you don't dismiss it. You translate it. You ask, what does the fortress see? What is being pulled? What is being leased? What is being repriced? What is being delayed? Because here is the core truth of every commodity squeeze. The public watches price. The insiders watch availability. The public watches candles. Well, the insiders watch trucks. So today we're going to build a clean forensic map of what 7% stress could mean, how it shows up, why it matters, and what happens next when a system built on promises starts getting audited by reality. And I'm going to do it without fairy tales. No tomorrow silver to the moon. No fake certainty. No guaranteed. Just logic, plumbing, and human behavior under stress. Because markets are not math problems. Markets are fear management machines. And silver is the market where fear becomes physical. If you're holding paper, you're holding trust. If you're holding metal, you're holding settlement. And when stress climbs, the world stops asking, how much can I make? And starts asking, will I get paid? So let us begin with the first layer. What exactly is the stress gauge measuring? Imagine you call a supplier and you want metal now. Not a contract, not a promise, not a line item. A bar, a pallet, a delivery date, and the supplier says, we can do it, but it costs more. That more is the stress. It's the premium for immediacy. It's the premium for removing counterparty risk. It is the premium for not being the last person holding a receipt when the shelves go empty. Now multiply that behavior across mints, refiners, fabricators, wholesalers, ETFs, hedge funds, industrial buyers, and sovereign entities. Now add one more ingredient. When stress rises, people stop selling because selling becomes regret. The seller thinks, if I sell today and the replacement cost is higher tomorrow, I just sold future security for present cash. And when that mindset spreads, supply doesn't just tighten. Supply evaporates. And the market doesn't clear with a gentle rise. It clears with a jump. It clears with rationing. It clears with no offer. That's the phrase you must fear, not high price. Because high price still means a market is functioning. No offer means the market is admitting it's not sure it can replace what it sells. So if stress is hovering near 7%, You're in the zone where no offer starts showing up in certain products, then in certain sizes, then in certain regions, then in the whole chain. And the paper market can ignore it for a while, but not forever, because paper needs physical as the anchor. Even the illusion needs a reference point. And when the reference point starts drifting, the illusion gets expensive to maintain. We're going to break this down in 5 parts. Part 1 is the warning and the setup. Part 2 is the anatomy of 7% stress and how the physical chain signals distress. Part 3 is the JP Morgan angle, why fortresses matter, why vault categories matter, why insiders watch flows, not headlines. Part 4 is the global map, where metal goes when the West underprices and the East pays up, and how industrial demand turns into geopolitical behavior. Part 5 is the endgame, what breaks first, what indicators actually matter, what traps retail falls into, and how to think like a risk manager, not a gambler. Because in this market, the winners aren't the loudest. They're the ones who understand settlement. Now take a breath and let's go deeper. To understand why 7% stress matters, you have to stop thinking like a chart watcher and start thinking like a supply chain operator. Supply chains don't care about narratives. They care about timing, replacement, and penalties. Silver is a small weight, high function metal, so when the system strains, it shows up fast as higher real world costs to get metal now. That's what stress is in practice, the growing price of certainty. Think of 7% like a pressure gauge. At 3%, people debate. At 5%, professionals get cautious. At around 7%, institutions stop joking and start securing. And they stop asking, where's the price going? And start asking, can we get the metal on time at size without surprises? Because under stress, the real risk is not volatility, it's delay. Delay is where rules change. Delay is where counterparties fail. Delay is where you discover you owned a promise, not a thing. So what does 7% stress look like in real life? It's a cluster of symptoms. First, premiums expand, especially on fast-moving products that require immediate fabrication. Coins, rounds, small bars, high turnover wholesale items. Premiums rise because sellers are pricing replacement risk. If they sell today and can't restock next week without paying more, they're selling future security for present cash. Second, delivery times stretch quietly. It starts as ships in 1 to 2 days, then 5 to 10 business days, then pre-order, then allocated only, then limits per customer. That is the market speaking without admitting it. Third, the gap between spot and street becomes obvious. You see one number on a screen and a different reality when you try to buy immediately. That gap isn't ideology, it's measurement. It measures stress, not opinions. Fourth, terms tighten in small but meaningful ways. Minimum order sizes go up. Quote, windows get shorter. Payment terms harden. Some suppliers won't lock a price without immediate funds. Some stop quoting certain sizes at all. That's risk management under pressure. Now here's the key mechanic behind all of this. There are 2 worlds, paper silver and physical silver. Paper is fast and scalable. Physical is slow and constrained by real capacity. Refiners, fabricators, shipping, and vault operations all have limits. So you don't need no silver on earth to get a shortage. You only need insufficient flow at the moment people demand certainty. Shortage is often a flow problem, not a total inventory problem. In normal times, arbitrage is the bridge between paper and physical. Big players can buy paper exposure, convert to physical, and keep spreads tight. In stress times, the bridge clogs because capacity is tight, terms are stricter, and the cost of immediate metal rises. When the bridge clogs, the gap widens. And once the gap widens, psychology flips. Sellers hesitate. They start thinking, if I sell now, can I replace it later? At what cost? With what delay? That hesitation reduces supply further. Reduced supply raises stress. Higher stress increases hesitation. That's how markets slip into no offer. Not because silver vanished, but because nobody wants to sell into a price that might be obsolete tomorrow. So what does physical market broke mean? It doesn't mean zero inventory exists. It means the posted price no longer reliably procures real supply at scale on normal settlement terms. The market can still trade on screens while physical becomes conditional, delayed, and premium priced. That's a broken clearing mechanism. And that's why 7% matters. It's the market visibly charging a fee for certainty. In a healthy system, certainty is assumed. When certainty becomes something you pay for, trust is fading. In the next part, we'll go into the fortress layer, why JP Morgan's posture matters, why vault behavior matters, and why insider warnings usually show up in flows and terms before they show up in headlines. Now we go to the JP Morgan layer. Because in silver, the real story is rarely the headline, it's the plumbing. JPM is not just a bank. In the modern silver ecosystem, it behaves like a fortress node, a place where paper flow and physical flow touch. And when stress rises, the fortress doesn't speak in interviews. It speaks through behavior, quoting wider, getting picky about terms, protecting inventory, slowing outflows, and tightening what it's willing to lend or lease. That is what an insider warning really means. Not one dramatic person whispering in a hallway, but the plumbing sending signals that the people closest to it cannot ignore. And this is where the phrase insider war becomes useful. Because inside large institutions, you don't have one unified brain. You have desks, incentives, risk limits, compliance, treasury, and politics. When markets are calm, those factions can coexist. When stress pushes toward a threshold like 7%, those factions collide. One desk wants to keep making markets because it earns spread and fees. One desk wants to reduce exposure because it sees tail risk. One desk wants to source metal urgently because it sees settlement risk. One desk wants to delay because time is safety. One desk wants to hedge because volatility can wipe out a month of profits in a day. So what looks like a clean institution from the outside becomes a battlefield of priorities on the inside. Here's why that matters for you. In a stress regime, price is a lagging indicator. Flow is a leading indicator. The public watches the candle. Insiders watch the truck schedule. The public watches spot. Insiders watch whether the same ounce is being promised to too many parties. But the public watches narratives. Insiders watch counterparty behavior. And when stress rises, the only thing that matters is this question. Will settlement behave normally? Now let's simplify vault logic without getting lost in jargon. Every custody system has a version of two buckets. Metal that is realistically available to satisfy delivery obligations, and metal that is privately owned and stored. But under stress, privately owned metal stops feeling safe inside systems you don't fully control, because claims can be layered, terms can change, and bureaucracy can suddenly become a weapon. That's when you see the late-stage confidence behavior. Withdrawals. Not transfers, not accounting reshuffles. Withdrawals. Physical metal leaving the ecosystem. And withdrawals are a bigger signal than most people understand, because inventory existing is not the same as inventory available. Inventory can be owned by entities that won't sell. Inventory can be committed to contracts. Inventory can be trapped behind delivery schedules. Inventory can exist on paper while the real supply chain is bottlenecked. So when someone says there's plenty of silver, the adult question is always, at what price, under what terms, and how fast? Now, imagine stress at 7% as a recurring condition in the background. It means the market is charging a visible fee for immediacy and certainty. That fee forces big players to make a decision. They either accept higher costs and secure metal now, or they gamble on time. And institutions hate gambling on time because time is where policy risk lives. Margins can change tomorrow. Regulations can shift tomorrow. Export restrictions can appear tomorrow. Credit can tighten tomorrow. So under stress, the institutional instinct is to turn promises into possession. That is where the JPM insider war becomes real. Some internal factions want to keep the machine running smoothly. Some want to protect the fortress first, because if the fortress is exposed, they become the headline. And in a physical stress regime, the fortress protects itself by reducing the market's effective supply. That action itself increases stress. The market tightens because the fortress anticipates tightening. And it tightens more because it sees itself tightening. That's the feedback loop that turns a squeeze nonlinear. So when we say physical market broke, we don't mean there is no silver on earth. We mean the clearing mechanism is failing. The posted price is no longer reliably pulling real supply at scale on normal terms. The system can still trade, but it begins to trade like a stressed organism. Spreads widen, delivery windows stretch, substitution happens, terms become conditional, and no offer starts appearing in places that used to be liquid. And once that begins, the question is not, can price go higher? Of course it can. The real question is, what forces a re-anchor? Because paper can only float above physical reality for so long before the market punishes the lie. And the punishment is always the same. Metal exits, stress rises, then price gaps or rules change. So here's your takeaway for part 3. JPM matters because it is a central node. And central nodes under stress reveal the truth faster than charts do. If the fortress starts acting defensive, you're watching the system move from a speculation story into a settlement story. And settlement stories end with repricing. Now we widen the lens, because silver stress is rarely local for long. Physical metal obeys the simplest law in commodities. It flows to the highest bidder, not the loudest bidder, not the best storyteller, the highest bidder. If one region consistently pays more for real metal, and logistics are possible, metal moves. And when metal moves, the region that underpays experiences scarcity, even if its paper market still looks deep and liquid. This is how two-tier silver markets are born. You get a posted screen price, and you get a procurement reality. The real delivered cost, depending on urgency, size, location, and relationships. In calm times, arbitrage keeps these worlds aligned. Big players can buy paper exposure, convert to physical, move it, and close gaps cheaply. In stress times, arbitrage becomes a drain because it removes physical from the underpriced market and ships it to the overpriced market. And as that drain continues, stress rises further because the underpriced region loses float. Here's the key concept. You don't need to run out of silver to create a crisis. You only need insufficient flow at the moment. Demand requires certainty. Refiners have capacity limits. Mints have capacity limits. Fabricators have capacity limits. Shipping has capacity limits. Vaults have scheduling limits. So when stress is already elevated, a relatively small surge in urgent demand can create outsized delays. And delays are the signal that causes hoarding. Hoarding is rational when replacement risk is real, but hoarding becomes the cause of further shortage. And that turns stress into a feedback loop. Now bring in the East-West dynamic. The West often treats silver like a financial instrument first. It emphasizes paper liquidity and derivatives depth. The East, especially where industry and physical procurement are front and center, treats silver like a strategic input and a hard asset. That means physical demand there can be less price sensitive because it's tied to production and policy, not just speculation. Solar buildouts, electronics, energy transition, supply chains, defense components, these aren't hobbies. They are national projects. And national projects don't wait for your pullback on a chart. So what happens when the East is willing to pay up for immediate physical while the West keeps a smoother paper price? A gap opens. That gap is not a curiosity. It is a vacuum. It creates a near mechanical incentive for metal to leave the underpriced zone and move to the higher paying zone. Every ounce that moves reduces supply where the paper price is referenced. And that raises stress further because the paper market loses its anchor. This is why silver behaves differently than gold under physical stress. Gold is primarily monetary. Its industrial burn is smaller. It can sit still in vaults without being consumed. Silver is consumed. It is dispersed. It is harder to recycle quickly at scale, and it is demanded by modern infrastructure. That makes silver shortages feel real fast. When industry needs it, they pay. They sign contracts. They pull forward demand. They secure supply chains. They stop caring about spot and start caring about delivery. And here's the political twist. When a metal becomes strategic, markets become less free. Not in a dramatic speech, but through friction. Export paperwork slows down. Vault withdrawals become more bureaucratic. Premiums explode in certain products. Size restrictions appear. Allocation becomes relationship-based. These are quiet forms of control. And they accelerate the migration away from a single global price toward multiple regional clearing prices. So in part 4, the argument is simple. If the West underprices physical relative to global demand, metal will leave. The drain continues until the West reprices upward to close the gap, or until the West restricts flow to stop the drain. Either outcome is bullish for a higher true price because it confirms scarcity and raises the cost of certainty. That guess what? Stress at 7% is really shouting. The cost of certainty is climbing and the world is paying it. Now we go to the final part, the endgame. Not fantasy targets, not guaranteed timelines, but scenarios, indicators, and the biggest retail trap when a market shifts from trading to settlement. Let's end with the adult conversation. The endgame in a silver stress regime is not about a single number. It asks about whether the posted paper price can still function as the primary reference for a market that is increasingly being ruled by physical constraints and urgent procurement. When stress is rising, the market is charging a fee for certainty. That fee shows up as persistent premiums, longer delivery times, conditional quotes, financing tightness, and defensive behavior from central nodes. If those signals intensify, you're no longer in a normal price discovery environment. You're in a settlement risk environment. And in settlement risk environments, the playbook changes. Here are 3 realistic scenarios. Scenario 1, the system buys time. Stress cools, availability improves, premiums compress, and paper and physical realign. This can happen if recycled supply increases, demand temporarily cools, or new supply hits the chain. But here's the catch. Once trust cracks, it doesn't heal easily. This scenario requires not just metal, but confidence. Scenario 2, manage fracture. The paper market keeps trading, but the physical market lives at persistent premiums and becomes more relationship-based. A 2-tier world becomes normal. No dramatic default headline, but the gap becomes a feature, not a bug. This is very plausible in silver because industrial demand can pay up and lock supply while retail fights over scraps at elevated premiums. Scenario 3, acute repricing. The market hits a threshold and the gap closes violently, not necessarily with an official default, but with a sequence. Quotes disappear for size, delivery stress spikes, withdrawals accelerate, then paper gaps to re-anchor to physical reality. This is the scenario that produces the moves people remember because threshold systems don't fail smoothly. They fail abruptly once the load crosses a limit. Now, what should you watch? Forget the noise. Watch what cannot be faked easily. 1, real-world availability and delivery terms. Are lead times stretching? Are limits increasing? Are pre-order notices becoming common? That's stress. 2, premiums versus spot. Is the market charging a persistent fee for immediate metal? If yes, that's the certainty tax. 3, behavior of large custody nodes and flows. Are large withdrawals happening? Are big holders taking possession? When metal leaves systems, it reduces float and raises stress. 4, industrial procurement signals. Any sign that manufacturers are securing supply aggressively is bullish because it's sticky demand, not speculative demand. 5, institutional language and rule behavior. When institutions start emphasizing orderly markets, temporary measures, or make sudden rule tweaks, that often means stress is being managed, not solved. Now, the biggest retail trap, trying to trade a settlement story like a normal momentum trade. In a settlement regime, volatility is weaponized. Margin changes, headline shocks, and liquidity events are used to shake out leverage and reduce immediate physical demand. Retail gets chopped because retail reacts emotionally. Structural players position with patience and terms. So what mindset wins? Risk management, not bravado. Understand that silver can be violently volatile even in a bullish regime. Understand the difference between paper exposure and physical possession. Understand your objective. Are you trading? Hedging currency risk? Protecting purchasing power? Sourcing metal for production? Each objective implies a different tool and different risk. And here's the clean definition to carry with you. A market is broken when the posted price does not reliably procure supply at scale within normal settlement terms. That's what physical market broke means. It's not zero inventory, it's failed clearing under normal expectations. So the conclusion is straightforward. If stress at 7% is real and persistent, the market is migrating from a speculation story to a settlement story. And settlement stories end with repricing or controls, because the system can manage perception, but it cannot print silver atoms. That's why this matters. Because once the world starts paying a visible fee for certainty, cheap trust is over. And when cheap trust ends, the repricing phase begins. Subscribe to Money and Empires. We don't chase hype. We track settlement. We track flows. We track the signals that arrive before the headlines. And if this is truly the phase where physical silver is breaking away from paper, then the next moves won't just be price moves. They'll be regime moves.